Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. And in light of what's happening here with the pandemic and what's obviously gone on in the stock market, there's been a lot of changes in a very short period of time, most of them to the downside, but of course not all of them. So what I've been doing is I've been trying to examine the market and scrutinize things as closely and carefully as I can, trying to identify opportunities that might have arisen as a result of this horrible crisis. And I forget about the disease for a moment. I'm really talking here about what's gone on in the economy and the market. It's been unprecedented in my career. But one of the stocks that's gotten my attention here is Network Appliance. It's now called NetApp, the old Network Appliances. And it's a technology company that really deals with flash array data storage as their primary business. And it's a very interesting stock for a couple of reasons. I want to, first of all, just look at it from a pure historical perspective, and more importantly, from a valuation perspective, because back during the tech bubble, which of course ended in 2000, which I'm not be able to show that very much longer, so I thought I'd take the opportunity to go ahead and do it here. This is a classic example of how the market can misappraise stocks. And I think that's one of the most important things for investors to understand, accept, and recognize, is that sometimes the market is absolutely, unequivocally, in no uncertain terms, wrong about the way it is valuing a certain common stock. And of course, back in 2000, on the tech stocks, it was crazy. Here we see a price earnings ratio of 498, I'll call it, rounded, and that's absolutely insane. In other words, you're paying 498 years in advance to buy this company's earnings. And ironically, that was at a time when the earnings were just getting ready to drop 62% as we came into the 2001 recession. And of course, as you can see, the stock price collapsed dramatically in a very short period of time here. It fell almost 95%. That's strictly a misappraisal by the market, ladies and gentlemen. Whether you want to believe it or want to accept it or not, you can't deny reality. And then these tech stocks stayed overvalued for quite some time after that. Now, as a result, we have this normal price earnings ratio reference line drawn here, which is really unrealistic because it's distorted by these high values. So let's go ahead and drop this. Let's cut this out down to a more reasonable graph. And I picked the period just before the Great Recession, which again, NetApp came into the Great Recession very highly valued. It fell, but it never got really that inexpensive, ironically. And then, of course, it rallied significantly through 2011 before the stock came back to reality again. Then in 2014, which you can see here by the white line, they started paying a dividend. They originally paid 60 cents a share. They raised that to 66, then to 72, and it was kind of a nice progression here. If we go ahead and look at that in the performance graph, you can see that they were growing the dividend by rather substantial amounts, 9 and 10%, which is good, and then 5% and 5.3%. That was until we got into the period 2018 to 2019. Now, one thing I want to point out before I go any further, I want you to notice this has an April fiscal year. Okay, so when you're looking at April of 2019 here, you're still in the fiscal year. It's the fiscal year end of 2019. The fiscal year 2020, which is this fiscal year, ends obviously at the end of this month, or it ends, I guess you would say, today. And again, the company has announced reporting sometime in May for their next earnings report. But we had kind of decent dividend growth. Then we had this major surge in the dividend. But even then, we're still running at a payout ratio in the 40 to 45 to maybe getting approaching 50% next year. Now, a couple of things I also want to point out before I go on. NetApp became very expensive by August of 2018. The PE ratio was almost 23. It's currently half of that. It's currently trading at a blended PE of 10.89. So that's obviously quite a bit lower than it was back then. And from that peak to trough, the stock has fallen 48%. And that's one of the risks of high valuation. And now it's become very inexpensive, trading at, again, about a 10 or 11. That's, similar to what we saw back here in January of 2016, which even at today's low valuation would have been a great time to buy the stock. You'd have been annualizing at 21%. You'd have more than doubled your money if you bought it in January of 2016 when the PE was approximately what it is now. It was 9.6 versus the current blended PE of 10.89. So the stock is very, very inexpensive. It now offers a 4.28% dividend yield. It has earnings yield of 9%, which is, my minimum threshold of 6.5 or 7, and it's clearly below this valuation reference line here, which I would call fair value for the stock. So I would say this stock should be trading, somewhere in the 60s, 60 to, as high as $63 a share. You can currently buy all you want in the 40s. So it's a very inexpensive stock with a good dividend yield. Now, looking forward, looking to the future, the company is expected to have a down year, a 9% negative growth rate this year, which I think partially explains. Now, this is drawing a PE of 10. I want you to notice that. This is only a PE of 10 because growth is expected to be very low, less than 1% for the next couple of years. But that's because it's -9, a +3, and then a +9. So what we have here is a very low growth rate. But if I put this into the normal multiple, which has been in the 14 or 15 range, then you can see that this could be a very, very attractive short-term total return, investment for us, 24, 25% out to fiscal year end 2022, which ends in April. And by next fiscal year, which ends again approximately a year from now or a year from today, we would see an annualized rate of return of about 39% for the year, assuming it goes back to a more realistic PE. Now, looking at this 15-year graph, you can see the PE range has been between 15 and 17. So I think the stock is very, very attractive at today's levels. I've just started doing research on it. I've overlooked it for years because it was overvalued, and it doesn't have a great long-term dividend streak, but I like the current yield. The company's BBB+ rated. By the way, that's a very strong investment grade rating. People, for some reason, have asked me, am I worried about a BBB rating? Well, that's an investment grade rating, and the answer is no. But there is something else about this stock that I think is important to look at. The company does have 54% long-term debt to capital. Now, on the Dividend Kings website, we do provide information on safety and valuation, and I want to go ahead and those of you who aren't subscribers at least give you a sneak peek of what the Dividend King subscribers get. This isn't our master list here, Network Appliance. The company is scored 10 out of 11 for quality. That'd be a 90% type number if you were looking at a report card. And for dividend safety, and I'll get into that a little more here, it's 5 out of 5. The payout ratios, again, as I showed you earlier, in the mid-40s. This was reported at a little different time frame. And it's considered to have a safe payout ratio in its industry at 60%, and debt to capital is at 54%, but an industry safe debt to capital is 40%. So the Dividend Kings kind of grades this out and says this would mean that you would have no more than 7% of your portfolio in a stock like this, but that's based on its quality scores, etc. So when I look at this company again, it's now become very, very intriguing. Now I can go through a lot of other metrics here, like for example, I'm looking at dividend coverage now. So I can go to operating cash flow here, and I see that the stock typically trades at around 10.8 to, or we'll call it 11 times operating cash flow. It's trading at 9 times operating cash flow currently. So again, it's very inexpensive based on this metric. If I go ahead and look at price to EBITDA, the company looks inexpensive as well. In fact, it's one of the lowest prices to EBITDA that the company has ever traded at. It normally trades at about 15.8 times EBITDA. You can buy it at almost half off 8 times EBITDA right now. There is one negative in looking at these basic fundamentals that I want to bring out, and that's adjusted operating earnings, which includes CapEx. There is expectations of negative operating CapEx, of negative owner's earnings because of CapEx considerations going forward. But there are reasons why I consider that not to be too much of a threat, because it is a tech stock. The company has made a recent acquisition, which I announced. They just bought this company, Virtual Desktop, and I talked about that in the written portion of this article. But I want to take a look now a little bit at some of the reasons why I consider the dividend of this company safe. In order to do that, I'm going to move on to fund graphs, or what we call financial underlying numbers, fund graphs. And we're going to look at cash and equivalents versus total debt. Even though the company's debt to capital ratio is a little high by industry standard, I want you to notice this company has over $3 billion in cash and about 1.7 or 8 billion in total debt. So I consider this company very, very solid. It's one that I'm currently researching. Any risk of investing in this stock is already priced in. If you're a long-term oriented investor, I think this might be one you might want to take a closer look at, as I am. Anyway, this has been Chuck Carnevale saying thanks for watching. If you like what you saw here and even enjoyed the sneak preview Creek at Dividend Kings. You might want to take a free trial and look at that as well. Anyway, thanks for watching. Everyone needs to be safe out here, not just with our health, but also with our investments. Thanks for watching.